Today, we'll dissect the top hydrogen sector headlines from the past week, highlight breakthrough projects, analyze shifting trends in funding and policy, and unpack what recent changes mean for investors, policymakers, and developers. Let's dive into these developments and see what they reveal about the evolving hydrogen landscape. All this on today's Hydrogen Podcast. The European hydrogen market continues to demonstrate impressive momentum. Just this past week, Plug Power finalized deliveries for the H2Cast project and clinched a contract for an additional 35 tons, providing a clear signal that industrial-scale hydrogen distribution can meet real-world demand at pace and scale. In the Netherlands, RWE and TotalEnergies secured over 500 million euros in backing for a 100 megawatt renewable hydrogen facility serving Rotterdam's dynamic industrial cluster. This project is especially notable, not only for its size, but for directly linking green hydrogen output to the decarbonization of high-demand urban and industrial energy ecosystems. Similarly, in France, Air Liquide has reached a pivotal phase in expanding its large-scale hydrogen production, deploying gigawatt-class electrolyzers. These advances underscore the real technological heft now fueling Europe's hydrogen supply chains. Still, the common denominator remains. Every major milestone rides not just on technical vision, but firm, enduring economics, contracted offtakes, competitive energy input costs, and stable policy signals. Across the Atlantic, the industry was rocked by Department of Energy's decision to pull $2.2 billion in funding for two major hydrogen hubs on the West Coast. This abrupt reversal, cited as a response to shifting project priorities and unresolved market challenges, served up a sobering reminder. No project, however visionary, can thrive without predictable financial stewardship and bankable business models. These hubs were intended as anchor tenants for regional decarbonization and infrastructure build-out, and with their future in doubt, developers and institutional investors alike are craving clearer economic frameworks and risk allocation. Further uncertainty looms over additional U.S. hubs, suggesting that project selection is set to become even more rigorous, favoring those who can demonstrate robust revenue streams, risk mitigation strategies, and discipline in capital deployment. Meanwhile, Asia-Pacific is stepping boldly into the international hydrogen race. China's National Energy Administration greenlit 41 pilot projects, pairing government support with prime market access to catalyze rapid commercialization of domestic hydrogen supply chains. This sort of coordinated policy, market push, is what the industry often refers to as industrial policy with teeth. Japan is also making waves. Sumitomo Electric's selection for the prestigious NITO research program positions them at the forefront of advanced electrolysis technologies. Their focus on next-generation anion exchange membrane systems underscores Asia's commitment to leapfrogging today's efficiency and performance benchmarks, boosting output and slashing operational costs at scale. Not every headline, however, signals unqualified progress. Germany's Hydro Hub Finna project, originally slated as a flagship 53 megawatt build, was cancelled despite locking in 100 million euros in European support. The cause? Soaring energy prices and insufficient downstream offtake agreements, reinforcing that even government-backed initiatives will fall short without grounded, competitive economics. This is a critical lesson. Project size must always be matched by an equivalent level of commercial and financial discipline. If energy sourcing isn't cost competitive and if market demand isn't contractually firm, technology alone cannot sustain the sector's growth trajectory. Still, it's not all re-entrenchment. Norway's Inversion E-Fuels just received zoning approvals for a 270 megawatt green ammonia plant designed to harness renewable hydropower for producing hydrogen derivatives. Projects like this illustrate that regions with abundant, low-cost, clean power and deep industrial demand remain fertile ground for hydrogen development. We're seeing a market uptick in government and industry competition, with the EU announcing 1 billion euros in tenders for hydrogen production. The sector's leaders continue to call for policy alignment, competitive neutrality across regions, and greater market flexibility. This sense of international competition is not just about national pride. It's a race to define cost structures, secure long-term offtake, and lock in supply chains ahead of mainstream adoption. And so, from a consultancy standpoint, let's break down a few key strategic takeaways. The first is revenue certainty wins the day. Projects will only attract meaningful capital if they secure long-term supply agreements with credit-worthy buyers. Fluctuations in government support, such as the recent U.S. DOE decision, shine a spotlight on the need for private sector discipline. The second is technology differentiation matters. Advances in electrolyzer efficiency, modular project design, and system integration are becoming important risk mitigators, directly affecting total project costs and flexibility. The third standpoint is energy input sourcing is decisive. Whether utilizing offshore wind in Northern Europe, hydropower in Scandinavia, or solar in the American Southwest, the delivered price of electricity will determine a project's global competitiveness. And so looking forward, here are three big questions that will judge our next moves. The first is who will close the gap between ambitious pilot projects and genuine large-scale hydrogen economies? The second is this: what policy levers, carbon pricing, contracts for difference, direct capital grants, will prove most effective and scalable? The third question to think about is this: how will developers manage offtake risk, and what sorts of buyer-seller partnerships will underpin the market's evolution? And so the final thoughts are this. This has been an extraordinary news cycle for hydrogen, one marked by both hard-earned progress and reminders that solid economics are the essential bedrock of a resilient global hydrogen economy. As always, technology and passion will drive innovation, but it's disciplined economics, realistic scheduling, and risk-sharing frameworks that will unlock capital and bring green molecules into mainstream energy and industrial systems. All right, that's it for me, everyone. If you have a second, I would really appreciate it if you could leave a good review on whatever platform it is that you listen to. Apple Podcasts, Spotify, Google, YouTube, whatever it is. That would be a tremendous help to the show. And as always, if you ever have any feedback, you're welcome to email me directly at info@thehydrogenpodcast.com. So until next time, keep your eyes up and honor one another.